Good evening. Thank you very much indeed for joining us here this evening. I'm Will Goodhart. I'm the Chief Executive of the CFA Society, and thank you for joining us. We're delighted to have here this evening Jerome Booth. Jerome is an economist, an entrepreneur, an investor, and an expert in emerging markets. And over the next 40 minutes, he's going to talk to us about why finance theory is wrong and why global asset allocations are wrong. So as I say, he's going to do all of that in 40 minutes, and then 20 minutes for questions, and we should have the whole thing wrapped up. He's very well placed indeed to attempt this feat. In 2013, he retired from the Ashmore Group, which is an emerging markets asset manager that he helped to found following a buyout from ANZ. And before working for ANZ, he worked in the strategic planning unit of the Inter-American Development Bank in Washington. And prior to that, he was a lecturer in economics at Christ Church, Oxford, and an advisor to the then Department of Trade and Industry. He's now chairman of New Sparta Limited, through which he manages his more active investments, which include controlling interests in a number of companies in insurance, telecoms, film, journalism, and publishing. And he's a visiting professor at Cass Business School, as well as the chairman of the governors at Anglia Ruskin University. And Emerging Markets in an Upside-Down World is his first book and was published last year and is available at all good bookshops and immediately outside this room in cash for £20. So we're delighted to welcome you, Jerome. Thank you very much indeed.
Thank you. So thank you very much. It took me a long time to write the book. And I think I went through 9 drafts because emerging markets is all about prejudice, and I wanted to get everything in and not have people say, oh, yes, well, that's true, but. You know, we have a lot of buts at the moment about China. In 2002, it was Brazil, but, you know, everybody has to have a reason not to invest in emerging markets because it's a prejudice. And prejudice is a part of our lives we have ticked the box in. We don't think. Thomas Kuhn is famous for the term paradigm shift, which has been massively overused. But originally comes from his book, The Structure of Scientific Revolutions. And he talks about how in natural science, when scientists move from a series of models, such as Newton to Einstein, this sort of takes quite a long period of time. There's a sort of sudden, there's an S-shaped curve. There's a sort of a movement of consensus, but there's also this tail where people basically you have to wait until they die before you get 100% consensus. And of course, Einstein himself very famously was skeptical about quantum theory until the day he died. So we have a world where people believe what they want to believe, and it's very difficult to change people's beliefs. And in science, you know, it's just the truth that most people do not work things out from first principles. And so you stand, as Newton says, on the shoulders of giants. You do something because others have done it that way before. The difference between science, as defined by Popper, science, he says, is thus. You cannot prove any theory. You can only disprove on the basis of evidence a hypothesis. But if something's not testable, then that's simply not science. You know, in economics, Milton Friedman said much the same thing. He said that if you have unrealistic assumptions and non-testable results, then it's not kind of very useful. And I would say that 90% of finance theory, whilst maybe academically or heuristically useful, basically falls into that category. And the real error is taking that and then using it inappropriately. And that has caused, in my view, a massive distortion in asset allocation. This has affected hundreds of millions of people in both the developed and the developing world. And I'll come on to that. But I want to start, as I've been told I must start, with my stories of dead bodies. And this is off a paper I wrote in 2011. I'd written a paper on the 5 stages of grief. And we're not going to get past the first stage, by the way, which is denial. So we have, in the UK, we've got a dead body. It's called a 500% debt to GDP. And it's fairly unpleasant. It's causing a big mess. We are arguing about the best way to clear up this mess. Should we be more fiscally austere? Should we have a nice, we're agreed actually we should have a housing bubble because that actually helps in the short term in a way that other policy levers don't, because it doesn't have the balance of payments or exchange rate implications that other traditional forms of stimulus does, and that's why a housing bubble is a really good response. But that's what we're doing. We're arguing about it a little bit. In the Eurozone, they also have a dead body. Their dead body is not in the spotless kitchen floor of Germany. It's around the edge in southern Europe. And the Germans are saying, we're not going to clear up your mess. You've created this mess. They do have all the cleaning equipment, of course, to clear up all the mess, but they're interested in incentives. They want strong institutions. And other members of the Eurozone are saying, well, no, that's not the way we do it. Let's just print loads of money, and we're not interested in strong institutions. So there's this argument going on. So the compromise is to take a sheet and to cover the dead body and talk about it later. Unfortunately, we need another sheet, a bigger one. Oh, and a bigger one. And the blood is sort of seeping under the sheet now. It's getting in the shoe leather. It's all a bit sticky, which, as you know, you probably don't know about that. And so that's in Europe, denial. In the United States, they've taken the dead body, put it in a chair, given it a cup of coffee, and they're trying to have a conversation with it. Because, of course, in the United States, we don't have a problem. My successor at Dana Ashmore has calculated that the debt to GDP in the United States, if you count the unfunded liabilities, is almost 650%. So when you read absurd comments in the FT, and there have been two now that I've counted, saying that the debt to GDP in China is bigger than the United States, total nonsense. You're not comparing apples with pears at all, and you're certainly not, you're being very selective in starting the numbers when you're not including policy response capacity, you're not including net reserves, etc., and lots of other things. So we do have serious denial. I suppose one of the most flattering comments I had from someone reading the book was an ex-deputy finance minister I used to work with in Washington who contacted me. I don't think I'd heard from him in 20 years or nearly 20 years. And he said, Jerome, this is the best book on economics I've read since the late 1970s. And that was very flattering because he was a Nuffield economist. So there is a bit of my explanation of what the global problem is. I take the view that if you don't understand what's going on in emerging markets today, you will not be able to understand the US equity market or the UK bond market. You cannot. There are two big structural realities, imbalances. One is the very high levels of debt in the developed world, and the second are what we call global imbalances. So I want to talk a little bit about those, and actually thinking about it, I don't have a clock I can see, so can you tell me when I've got 5 minutes? Just like that, because otherwise I'll go on all evening. The base, I'm going to give you the history of macroeconomics now. First of all, we have two things that they didn't have in the 1930s. Keynes invented macroeconomics. And secondly, we have the emerging markets as a potentially huge source of global aggregate demand, which in a non-inflationary form basically means investing in infrastructure to unlock bottlenecks rather than investing in things which create more. But that's entirely possible. We could spend trillions and trillions investing in emerging market infrastructure and maybe real estate to some extent, particularly affordable housing, and we would actually unlock further productive potential and raise growth rates and, importantly, demand for all of us. What Keynes's theory in one sentence, apologies to Keynes, is as follows. Though I'm going to give you another definitional sentence first, which is the difference in risk and uncertainty. Frank Knight in 1921 made the distinction that if you have random events and you know the probability distribution, we call that risk. And the thing about risk is that you can hedge or insure it. Uncertainty, or as he calls it, one-off events, you don't know what the probability distribution is. Maybe it's a one-off event, so you don't, there isn't one. Keynes's theory, very simply, is that when you have a lot of uncertainty, entrepreneurs will not build new factories, employ more people, they will wait. And that itself, if sufficiently large, can have a positive feedback on other entrepreneurs. It creates more uncertainty for others, which then has this positive feedback, which creates a depression. And that's his theory. Very simple, beautiful theory. He was criticized, John Hicks, who was the first person really to come up with this idea of the ISLM curve, but that's as technical as we're getting, by the way, which is the standard way that Keynes is taught, these two curves interlocking, crossing, Hicks was criticized at the time for ignoring this uncertainty element of Keynes's theory. And for years, we've had this sort of just belittled, and we've had the so-called microeconomic foundations of macroeconomics. And this sort of fudging, as, trying to fit square pegs in round holes, etc., has been not just a sort of Chicago school, but the new Keynesian approach, trying to assume that microeconomic theory can explain macroeconomic events. And that hasn't really mattered until now. It matters now because we've got real risk of depression. And I'm not talking just about 07, I am talking about now. Why am I talking about now? Because another Lehman's, in fact a bigger one, is very possible today. Dodd-Frank, basically, which is already, there's backtracking against it, actually took away the powers that the US Treasury and the New York Fed had at the time to intervene in AIG and the money markets. They've actually not got that. They would need new legislation to intervene if there was another crisis. And the levels of indebtedness have not gone down, by the way, still going up. So is the regulation much better at a micro level? There have been improvements, but basically we haven't yet resolved the problem. We've regulated some pools of finance better, but not others. So we still have so-called shadow banking, particularly in Europe. This is getting ever bigger. So there are some serious regulatory issues. Why did the problem start? There are two basic reasons. One, we had a sort of dalliance. I would say Greenspan in particular had a dalliance with laissez-faire. The assumption was, we'll pick up the pieces after the crisis rather than pretend, trying to resolve them. And this is coming a little bit from the misunderstanding that assets are not like goods markets. In goods markets, with one major exception, the Giffen good, when a price of a good goes up, demand goes down. In asset prices, that ain't true. And that's why you can get massive overshooting, and that's a prime case for regulation. We ignored that. The other reason was because of these global imbalances, which was basically a massive export of capital from the net saving countries, emerging markets, to the developing countries, pushing down the entire US yield curve and creating an artificial sense of risk. So what's behind that? Well, we have to go back a little bit. This is not the first time that we've had this global imbalance, by the way. We had another very big episode building up in the 60s. It starts with something called the Triffin dilemma, which I'm not going to define, but it's to do with the internal and external imbalance inconsistencies when you have a central bank, which is a central bank to the world and to a single country, in this case, the United States. Basically, if there are the global and the domestic economy are growing at different rates, say the international economy is growing faster, that requires an increase in the money supply, otherwise you get stagnation. And if the money is all printed in the US, how do you get it to the rest of the world? Well, if you're not careful, you do it through a build-up, an imbalance, a build-up in the liabilities of that country. So in the case of the 60s, what was happening after the Bretton Woods Agreement in '44 had effectively a pegging of currencies to the dollar and the dollar convertible to gold, the old treasury rate of $35 an ounce. That came under pressure in the 60s because the debts of the United States became greater than their stock of gold. And there was massive speculation in the London gold market against the dollar, and this was only prevented for much of the 60s through what's known as the gold pool, an agreement between central banks of the creditor nations, who were then European central banks, already en route to the European project. The central banks talk to each other, their dealing rooms talk to each other every day. All foreign exchange transactions went through them. They had huge ability to control this market that they don't have today. And there are only 7 of them. And even so, some of them cheated. And eventually, when the brash Treasury Secretary from the US finally said at a conference in Europe, the dollar is our currency, but your problem, That was the last straw, and the Bank of England asked for their gold back. Thank you very much. Chaos ensued. The Nixon came off gold, and the dollar went from $35 to $194 an ounce. And that's a devaluation, by the way. And that's a crisis. Now, other currencies fell at the same time because they were pegged. We then had a decade of inflation to wipe out the debt. That was global imbalances. We never really established, we never fixed the monetary system since then. I was at a conference about a year ago of central bankers, and we had the sort of grey hairs of central banking world, and there was the final panel with them all on, and they were basically saying semantics. One of them said, you can say it's dysfunctional, I just say we don't have an international monetary system. And that's really the essence of it. We don't have one. And we have this huge centrality of one currency, which is very, very unhealthy and very destabilizing. And the point is that when you've got huge debts on one side and you've got one creditor with this problem of having a central bank, which is effectively the central bank of the world, you are going to get the same problem again. And that's exactly where we are today. So after the Asian crisis, the Asian response was to self-insure. The IMF wasn't doing the job of insuring them adequately without onerous conditionality, so they decided to self-insure, which means build up their own reserves. A historian in a few decades might look at what's this period and think, there's something very odd. Why is it we've got the capital-scarce countries of the world with the highest potential rates of growth, and they are exporting capital? Not only they've got 30% savings rates, they're exporting huge amounts of that capital to countries which are basically bubble economies and are already massively levered. And that's the reality. And that flow is still continuing today. So think of a drug addict. I'm talking about the United States economy here. They have been addicted to debt. They had a negative savings rate. Come on, I mean, this is, this is not sustainable. As Herb Stein, advisor to President Nixon in '71, famously said, and I love this, it's very Forrest Gump, when something's not sustainable, it will stop. It's true, guys, it will stop. So we have a reality that flows to the United States were interrupted because of Lehman, and then the response has been, oh, give them more drugs. So the flow today from emerging market savers to the United States is still the big flow. So when you read in the press about taper tantrums and the threat of interest rates in the United States causing problems for emerging markets, most of that's nonsense. If I'm a central bank and I've got $300 billion in reserves, that means I can intervene and change my exchange rate at will anytime I want. Remember, Algeria has more reserves than the United States, right? The United States is not a reserve player. They just print money. They don't have anybody else's reserves. Usable reserves, non-IMF, non-gold. They don't really have very much. So we are talking about a world where the net creditors, over 85% now of reserves in central banks, are owned by emerging market central banks, and still growing. So this is the response. They have not responded. So if, in this environment, a few marginal amounts of money move away from emerging markets, and central banks in emerging markets do nothing, and their exchange rates go down, which they may in the short term find convenient, that tells you nothing about what they would do if you had a situation like '71. If you had a situation where actually they were seriously worried about their $12 trillion invested in the so-called liquid bonds alone of Europe and the United States and Japan. It's mostly Europe and the United States. And that's not including the other $5 trillion from sovereign wealth funds, by the way. So this is 2 orders of magnitude more than the potential flow from Western investors out of emerging markets. It's not even close. And yet we have this fixation of always thinking about investors as if it's the private Western investor that drives everything. This is what I call in my book core periphery disease. I call it a disease because it's a deep 2-century-old at least meme, an intellectual virus. The idea that the core affects the periphery, but we can ignore the effects of the periphery on the core. The idea that what we do and we think will affect emerging markets without realizing, without even asking the question, well, how much emerging market money might leave the US Treasury market if they got seriously worried? The answer is a lot more than would flow the other way. So this is a global imbalance. It's also a massive collective action problem, and I've probably said enough about it. And I say a lot more about some solutions and the need to go to a multi-currency reserve system in the book. The other big problem, of course, is the debt. And I want to spend a moment on the debt before I get on to finance theory. The build-up in debt, Bernanke was a student, or is a student, of Keynes and the Depression. And he realized very quickly that there was a problem. Normally, when you have a banking problem, you intervene, you seize the banks, you fire the management, and you work out very quickly which lending activities are essential for the economy. You promote those, and you basically fire other people and control the rest. And you have a bad bank or some sort of vehicle where you can basically take the losses and move on. We didn't do that. We didn't do that in the Western world for political reasons, bank lobbying, whatever. Instead, we sort of messed about for a bit, and eventually the stress tests in the US provided some credibility, and the banks there, at least, have been recapitalized quite effectively. In Europe, not yet. And the stress tests, of course, in Europe are not credible in the same way. But in the interim, in the immediate sort of post-crisis period, Bernanke saw that there was depression risk. Banking sector is a bit like a glass of water. It's got liquidity in it. And what you want is the liquidity come to the top of the brim and then go out into the real economy. And if it's a $2 trillion glass, or it's got a $2 trillion hole, and you put $1 trillion in it, it doesn't make any difference at all, which is more or less what TARP was and others. So the fiscal response had failed. And Bernanke into this came up with a very unusual policy of quantitative easing, which was basically there not to stimulate the economy, but to rescue the banks and so avoid a depression. And even in the design of QE1 and 2, we had the creation of a steeper yield curve, which was bad for housing, and people were puzzled about this. It's to help the banks. And that's been very successful. But if Bernanke had said that that's what it was for, very blatantly, of course, then that begs the question, oh, that means he must be really worried about depression. And that creates the uncertainty, which then creates the depression. This is Keynes. This is why I told you about Keynes. So this is about confidence. It's the emperor has no clothes, so let's tell everybody he's got wonderful clothes and get busy knitting. That's what's going on. And QE has gone from that into now it has a second function, which is all to do with financial repression. After the Napoleonic Wars, this country had debts of about 250, 240 debt to GDP. And it took us basically till the end of the century to get that down to reasonable levels, certainly 40 years to make a really good dent in it through what we would now call fiscal austerity. Pitt introduced income tax and all sorts of horrible things. We're not going to do that. We're just not going to do that. It's politically a no-go. So we have two, and only two ways really, tried and tested methods, both tried very effectively in last century to get rid of the real value of that debt. One, I've already mentioned, it's inflation. That's not the preferred option. It's rather sudden, but it involves the same mechanism as the other, which is called financial repression, which is basically a negative real interest rates, which is basically robbing savers. That's what it means. The best option, financial repression, is when you rob savers without them really cottoning on to what's happening. So financial repression is defined as any policy which captures domestic savings in order to fund the government and to do so at a lower interest cost to them than would otherwise be possible. So what you have is quantitative easing is now part of that process of creating almost no interest rate, and then you have inflation at 3%, and over a decade that'll significantly erode the value of the debt in real terms. You then have regulatory measures to say that pension funds, insurance companies and banks have to, for prudent reasons, invest in our debt. And that's why you get negative yields, for heaven's sake. What a nonsense world we live in. So people know, we know from behavioral finance, by the way, that people don't mind being robbed slowly, especially if it's other people's money. So that's where we are. And the risk is that people cotton on that they're being robbed and then demand a steeper yield curve. And that's the real threat when growth finally really recovers through proper consumption-led growth in the United States, which will probably happen back end of next year, which in turn is driven by the key issues of what the consumer is up to, which is a function of the household debt to income, which is the key measure. But the optimal policy for a central bank governor like Carney, therefore, is again, more cloak and daggers. It's actually to, every 6 weeks or so, tell the markets a different version of how the economy is doing to the one he'd said 8 weeks previously. So we constantly get distracted by his views on inflation and growth without realizing all the time that inflation is 3% and he's robbing us. Right? And as a taxpayer, I think, well, that's absolutely right. As a saver, I'm outraged. And then there's the marginal, these are conflicting objectives for government, but then there's another kind of incentive which sort of favors robbing people in this way, at least until they cotton on. And that's the fact that we can bamboozle emerging market central banks also to buy the gilts. And that's just a win-win, because they're definitely going to lose. So, collective action problem. If you don't understand these two big imbalances, you're not going to understand what's going on. I pity the poor, wire journalist at the end of the New York Day who tries to work out what happened that day when equities and bonds both went up. That's not going to happen. So he phones around, a dozen people, and a couple of them just hit on the same story. So he prints that, and everybody reads it. Oh, that's what happened. This is the sort of world we live in. That's uncertainty. This is people not really having a model. When we have the dollar just goes up and up and up against the euro every day, and we have people like McIntosh in the paper the other day saying, oh, well, the fundamentals mean it shouldn't move up again. We all know that's wrong. We know it's going to move up again. Why? Because this has got nothing to do with fundamentals. The idea that things are priced in is nonsense. People are, if they started to really think about fundamentals, it'll scare them so much that they just don't know what to do. Because the fundamentals speak for themselves. Debt to GDP, fiscal stuff, negative yields. There is no significant, credible scenario where a buy and hold investor for a gilt or a treasury or a bund is ever going to get their money back. There's no credible scenario. But it's not risky, of course. Well, what does that mean? Risk has 17 different meanings. For most, there's a famous quote by Alan Buter. He says, from Willem Buter, he says, this is actually about the efficient market hypothesis, but he says, this is perfectly obvious to anybody without a postgraduate degree from an Anglo-Saxon university in economics or finance. There is a sense in which we've got so focused, as Thomas Kuhn was saying, on, without going back to basics, without going back to, first principles, that we've just got entangled our own internal logic. Well, that's theology. That's not science. They had appeals to authority and peer reviews and logic for hundreds and hundreds of years before what we would call modern science came along. But it doesn't necessarily lead to progress. It doesn't really necessarily lead to anything more than inner enlightenment. It doesn't tell us what's going to happen next. It might tell us quite a lot about our own behavior. If you understand how other people behave, that's another matter. So I was thinking about this. I think there are problems with economics, but with finance, it's worse. And I really welcome the opportunity to talk to the CFA. This might sound a bit odd, but I've been talking to CFA groups all over the world. And I really must say, I think it's great, because this is a learning institution, and you want to know, what the other view is. And I think it's very important. But we all know, in our heart of hearts, the moment we've, operate in the market environment, a lot of what we learn in theory, we know is just unusable. So when I read that, for example, one of the things that really got my heckles going was actually where it said in a book, the capital asset pricing model doesn't really work in practice, but it's well grounded in theory. No, it's not! Richard Roll demonstrated very clearly in 1977 that the Fisher-Black equation was entirely circular. It's therefore not subject to any disproof. It is not science. It is not okay in theory. Absolutely the opposite. It's about as opposite as you can get. So where did the problems start? Well, some of the problems I sort of take back to the 1950s, and Markowitz wrote a monogram of 360 pages in 1959. And he talks about how the variability of a stock price can be understood in terms of the variability of that, or the idiosyncratic risk. He's talking about volatility, but he calls it risk. The idiosyncratic movement, which is not correlated to anything, stock-specific. The covariances or correlations to other stocks, and a correlation to an index. And this is one line. He then says, but for computational ease, we will ignore the correlations to other stocks. This was in 1959. We've sort of gone a bit further in computers, by the way, since then, but that doesn't actually help you because the maths is still complicated if you don't make that computational assumption. But this, I think, is behind a lot of our, I think, erroneous thinking about the role of asset classes, for example. The idea that asset classes are somehow representative or building blocks in an asset allocation process. I don't believe they are. In fact, I think that asset class or indices should not be used at all under any circumstances in the process of asset allocation. They are massively unrepresentative of the available investable universe. Andrew Smithers, in one of his books, wrote about, a very good book, wrote basically, there's a lot of theory behind it. He said there are only two fundamental ways to value a stock or any asset. One is some sort of replacement value, Tobins Q, and the other is, which is the one we really care about, by the way, not the replacement value, some form of income, seasonal adjustable income. That's what we want, income. So what we really want on a global scale, if we're trying to do the broad sweep theoretically about asset allocation, we want to look at global income and future global income. What's the best measure of future global income? Past global income. And what's the best measure of that? GDP. And, well, that means you should be 50% in emerging markets today, if you're neutral. Not if you are worried about the heavily indebted developed countries, as I am. In other words, like me, you would be much more weighted to emerging markets, as I am. Because all my telco, a lot of that is India, as it happens. And my journalism is all in Eastern Europe, or most of it, etc. So we have, but that doesn't fit neatly into our traditional way of thinking. A toddler, up to a certain age, when they leave their bedroom and close the door, don't believe the bed that they just slept in exists. It's a cognitive thing. In finance theory, if we can't measure it, we just ignore it. Just ignore it. Uncertainty, ignore it. What does risk mean? Well, for most investors, large permanent loss is a lot more important than volatility. But we can't measure that, so we just measure volatility. So I don't have, Keynes's book was 80% hatchet job on Marshall, and then beautiful theory, which I've described very poorly in one sentence. My book is hatchet job. Unfortunately, I don't have a beautiful theory to replace it with. I'm just pointing out that it's hard work, and we have to think, and this comes back to prejudices. Difficult. We don't like thinking. It's tough. The biggest problem of all, though, is agency problem. Principal-agent problems. This is the traditional problem or subsector of economics where we have a principal, an owner of capital traditionally, who has limited information about their agent or manager who actually works for them. And we have an incentive contract to ensure that the manager maximizes their effort and all that sort of thing. But agency chains, agency problems, cause distortions in decisions, and we know that. And our industry is rife with agency chains. So we have, say, take a pension fund, say a public pension fund in the US. You have the end saver. They're the principal to their agent, the trustees of a pension fund. The trustees, in turn, are principals to their staff. There's an agency chain between both the trustees and the staff to consultant. The consultant, by the way, who gets their money from asset allocation will tell them that asset allocation is much more important than manager selection, and the manager will tell the pension fund that the manager selection is much more important than asset allocation. So there's agency problem again. And then, of course, they've got an agency chain with the managers, and the staff of the pension fund has. And then, of course, the trustees have got an agency problem with the regulator, that is the government, that also has an agency problem with the voter, who is the saver. And, of course, then there are several regulators involved. So anybody that puts up their hand and says, oh, I can't do this, I've got career risk, they're actually putting their hand up and saying, I'm not representing your interests because I've got an agency problem. And the biggest agency problem of all is the fact that we know that finance theory has limited use, and we use it anyway because we don't have a clear alternative and everybody else does it. And this is ethically wrong. It's a breach of fiduciary responsibility on a massive scale. And it's no excuse saying there isn't another easy theory. It's no excuse saying, oh, it's difficult to think and nobody else is doing it. So my book is a call for people to start thinking strategically, to start emplacing particularly macroeconomics, looking at the structural problems in the global economy at the front. So I ask questions like, look at your assumptions. You're assuming sometimes that volatility is the same as risk. Under these circumstances, it might be a counter indicator. Under these circumstances, you just don't want to assume that anyway. But in other circumstances, it might be a good proxy. So just work out when your assumptions, when your models are relevant, when they're not. And I've been told there are two innovations which are really new in the book in terms of the body of theory. One is this idea about what is strategic thinking. When the tanks were rolling into Belgium in 1939, the pension fund trustees, they've got a choice. Do they say to each other, well, we haven't got another asset allocation meeting for 3 months, so we'll wait? Or do they grab everything that isn't fixed to the floor and run? At the moment, they would basically decide that it's not time to have a meeting yet. We have, I think, a long way to go before we get to the objective where strategic thinking is a daily exercise. People teach the Yale model in colleges across the world. What did Svensson tell us in the Yale model? He said, and by the way, the Yale model is a huge advance on what was there before, because before that, going back a little bit, there are only two asset classes in the world, treasuries and US equities. World outside the US doesn't exist. So we've moved a long way, because we now can invest abroad, we can invest in things that aren't liquid, but we're still troglodytes. We're still the guy that invented fire. Yes, great technological innovation, but we're still basically static. He's still saying things like, we know that there are behavioral biases and people are rational sometimes making decisions, therefore we'll only have a strategic decision once a year. That's suboptimal. The fact that people have behavioral laying, they have various parts of the portfolio they set aside for capital preservation, for income, for higher risk levels. All this is behavioral nonsense. It's all been critiqued. It's all suboptimal. It's absolutely equivalent to having different jars on your mantel shelf, one for bread, one for jam, one for your TV subscription or whatever it is. It's just not, it's not optimal. And so we have a lot of rules of thumb which have grown out of the confusion which is finance theory, the lack of guidance. And we need to rethink some of this. The whole active versus passive debate, the whole asset allocation debate versus manager selection, etc., which I've gone through. So I go through quite a lot of those details. The other, I said there were two theoretical innovations. The other one is affects investors and regulators. When I was at Ashmore after 2008, they have, I assume, still, a weekly investment committee meeting. And we would maybe spend another 2 hours talking about the markets in those meetings in the crisis period. And basically that entire extra 2 hours was taken up looking at a very granular level at who owned, in our view, the particular instruments. And the reason we were doing that was because we wanted to work out how the investor base for that asset might behave in this scenario in the future. And then by adding that up in a very granular way, it gives us an overall idea how the whole portfolio might react in that scenario. And that then tells us now whether that was acceptable or we had to do something with the portfolio now. It's no good just measuring or banning, say, derivatives without understanding the motives of the people behind the transaction and what is actually happening in terms of incentives. The Brazilian regulatory structure is much better than the US one or the UK one even, because they have every financial instrument is registered. And that means that if there's a problem, the central bank knows exactly where to intervene and how much. We haven't got any chance of doing that in the US, and there isn't even one regulator. So we have an example, for example, where say I have an investment bank, goes to a corporate client. Corporate client is worried about the asset that they've just bought falling in value suddenly. It might be an exchange rate, it might be an equity or whatever. And so the investment bank persuades them to buy a hedge. So they insure themselves, they pay a fee to the investment bank. The investment bank then, if it's a liquid market, they would go and lay off that risk. But say it isn't a liquid market. Well, then they sell the asset. What does that do? Well, that causes the price to go down. Oh, the hedge is then needed. They hedge it, and the investor thinks, wow, that was useful. I avoided that risk. That was really good. But actually, all that's happened is they've just paid the investment bank a fee. So you have to understand the structure of the who owns what, really, to start to get a grips on not only how to invest, but how to regulate. And so I'm proposing maps of who owns what, but also at a second layer, maps of investor perceptions. And what I think is really fascinating in our business is how people do have different models. This is back to Kuhn. They do have different versions of reality. And the really interesting periods, worrying periods, crisis periods, are when these views suddenly change. So my second son did a couple of degrees in economics, and during one of those degrees he sent me a paper and a question. It was about the Thai crisis in '97, and he said, this author is saying that everybody predicted, that nobody predicted the Thai crisis. That's not right, is it, Dad? And I was thinking, no, of course it's not right, because I remember telling people 6 months in advance to get out, and that's not because I'm some sort of genius, it's because I can read. The IMF was warning at very clearly there was a balance payments crisis, and if that's not good enough, George Soros had a very public speculative attack on the Thai baht, which only failed because the Malaysians and other central banks bailed the Thais out. So what is an academic doing years later saying nobody foresaw this crisis? And then you read on, because the spreads didn't move until the last moment. No, that means some people didn't get it, not that the market didn't. It means some people didn't work out there was a problem. So we've got people with different models. So the people who get it, the people who understand IMF-type thinking, who've seen a balance of payments crisis maybe in Latin America, know, oh, all the signs here, I'll get out. They exit, to use Hirschman's phrase. And what's left are those guys that have a different view of the world, and they see an arbitrage, very small, and they just put a little bit more in. And this happens because people exit, they get their lights go on at different moments. They're all having their eureka moment. By the way, once you've got Einstein, you never go back to Newton. You don't go the other way. It's a one-directional move. And they slowly exit, and what you get left with is increasingly a homogeneous investor base with one view. And when they get it, they all want to sell at the same time, and that's when you get your crisis, your liquidity dries up, and you've got a massive problem. So I have 3 warning signals for systemic risk. One is that, homogeneity of the investor base. That's why doing this mapping is so important. Second is a misperception of risk, which may shortly change. So calling something risk-free, that's an abuse of the English language. There's no such thing as a risk-free investment. But calling something risk-free does tell you that the risk is misunderstood. But is that sustainable? May or may not be. That's the next question. Is it unsustainable? Might be. And the third, of course, is leverage. Leverage basically causes all sorts of problems. It doesn't have to be in the instrument either. It has to be leverage which somehow affects the behavior of the investor base. So it might be a margin call, it might be at the economy level. So in this way, we have, I think, to move from the traditional way of thinking about asset allocation as a sort of very simplistic tick box exercise into, I want to get macroeconomics and history and anthropology and policy making, politics, right back at the forefront of how we think about how to allocate assets. It's absolutely essential in a period of history where we've got these 2 big imbalances I mentioned. And that's the prudent thing to do. And the current method of doing things just doesn't work, doesn't do that at all. Lastly, because my time's up, I want to give you a definition of emerging markets. I define emerging markets in terms of prejudice, and I want to preface this by saying that in the beginning of Anna Karenina, Tolstoy says that happy families are all happy in the same way, unhappy families are all unhappy in different ways. And what's interesting about the emerging markets is they're much more heterogeneous than the developed world. And that actually should mean that they're much better risk diversification than the developed world. And we have what we call foreign bias as well as home bias, where people invest in countries similar to themselves. If you're worried about high levels of leverage in the UK, and your response is to invest in France and the United States, God help you, because that's not the solution. When Lehman in the US failed, there were press articles. Oh, Lehman in the UK is okay because it's got $6 billion in cash, and then that transfer obviously went to New York. You can't escape the fact that if economies are highly integrated and there's a huge amount of financial leverage, they're going to all fall like ninepins. So diversification means going to emerging markets. Why do we have this term of emerging markets if they're all so heterogeneous? And the answer is that the traditional answer, up until 98 and never since, is that you did, in those days, have a common problem which they were all subject to, which was if you cut them off from capital, they would have balance payments crisis. Today, they're net creditors, so that just doesn't occur. You know, 2001, Argentina defaulted, and every other country in the emerging debt index rallied within 48 hours. Every single one. And we're just not in a world ever since when I haven't seen any crisis since 98. That was the last one where I've got seriously worried about the asset class. Everything basically is a buying opportunity. Doesn't mean you catch the knife whilst it's still falling. Sometimes you wait for it to drop to the floor before picking it up. But basically, we're not in that world anymore. So what is it that defines emerging markets? The answer is prejudice. And this is it. All countries are risky. Emerging markets are the ones where that risk is perceived, where it's priced in. It's the developed markets where the risk is not perceived and not priced in. And that's actually where most of the risk is today. So the world is upside down. Thank you very much. Okay. So we've got some time for some questions.
Thank you very much indeed. That was fascinating and great fun. How likely do you think it is that we could move to a new approach, a new way of thinking about investing, the sort of approach that you're talking about? And the sort of more specific question that I have is, which players do you think might benefit from a change in approach? Because it's hard to see how you sort of get the thesis, but I'm not sure I understand who would benefit from that. And until you get a sense of who owns, in the same way, you know, who owns the securities, who owns the benefit of a change in approach in your view?
I think there are two main beneficiaries. Well, three actually. One is the emerging markets benefit because they get the capital that they should be getting. Secondly, the taxpayers who otherwise are going to have to bail out financial systems again benefit. And of course, thirdly, the savers benefit. But it's the savers that are crucial because without savers really wanting this change, nothing's going to happen. So unfortunately, I think we need another crisis for it to happen, or maybe just a period of inflation. Let me give you another example why, how savers being robbed might actually get into the public mind and how regulation may change. So people talk about liabilities, and most of what people talk about when they talk about liabilities is subject to money illusion. In other words, it's all a nominal debate. Of course, if you go through a period like the 1970s, and you have a real inflation in double digits for a few years, and then you get your £2,000 a month pension and it buys you a loaf of bread, you're not going to be very pleased. And then you're going to ask your pension fund, why is it that I've got basically no pension when you promised to meet my liabilities? And they can say, oh, well, we promised to give you a certain sterling amount. And you say, well, that's not my liabilities. My liabilities are determined by what I want to buy in my retirement. That means I want to buy a new car, and I want to buy the petrol to put in it, and I want to buy some food. And so the moment you start thinking about that, suddenly it changes your asset allocation. Instead of thinking that just putting your money at home into gilts where you get negative return, and that's the best scenario, you actually start realizing, okay, well, where are my liabilities? We're an open economy. Say, take the car example. So in 20 years, when I retire, 90% of the world's cars are going to be produced and consumed in emerging markets. The oil price, commodity prices, it's very much the case already that emerging markets are price makers, but it's going to be true in cars. It's going to be true in a lot of goods markets. And that means that if you're not invested in those countries today, then you are gambling away from your liabilities as a pension fund. So that is a huge error of perception of, we need the public pressure, though, to say, sorry, we want our liabilities defined in terms of our future purchasing power, because that's actually what we want. And that's not going to happen until you've got a real sense of loss and problem for those pensioners and a real articulation of that problem. And I'm afraid, in a lot of senses, that's only going to happen despite my lobbying for it. And I hope, of course, by talking to the CFA and you spreading the word and all reading my book, that we can actually do better than that. But I'm rather worried that it's only through crisis that you're really going to get the political
education, if you like, and motivation to change policy, which is actually where we need to go.
Thank you very much indeed. I really enjoyed your talk. I just wondered about, you mentioned homogeneity of investor base. Do you think ETFs are about as big a homogeneity of investor base as it's possible to have?
Yeah, it is a bit of a problem. I mean, the idea that an index tracking investment is safe is equivalent to saying, and sometimes it may be, but I mean, it's equivalent to saying that if I'm driving a car and I close my eyes, then I'm going to save energy. It's not untrue. You will save energy, but you also increase the risk. I mean, Argentina in '01 is a really good example. Nobody who didn't see that there was a massive risk of Argentina defaulting in '01 really has no business managing other people's money in emerging markets. I mean, it was so obvious. So the only people who really lost were, of course, the passive investors and the ETFs that just had a non-thinking approach, the tick-in-the-box approach, in order to save fees, shall we say, whatever the motive is. The point is, they're the people that really lost out because actually it was 20% of the main index at the time. So they really lost out. So the idea that somehow the index, you see, the asset class, the index is somehow low risk, and any active management on top of that only adds return and risk is, of course, false. Likewise, we have, and it's taught, in business schools across the world, if you take, you add stocks to a portfolio randomly, once you get to about 15 stocks, you can't really get much more diversification and much reduction in volatility. But the key word here is randomly. If you don't do it randomly, and you don't just do an ETF, and you actually think, oh, actually these particular 5 stocks are actually much less volatile, much less risky than these 5, you just have, then of course you're going to get a lower volatility and a lower risk portfolio. It's just common sense. So, the trends, the fads, and why an ETF to an index? An index is, basically a pretty arbitrary thing. Asset class is even more arbitrary. An asset class appears to be, well, in the beginning, as I mentioned earlier with the Svensson talk, there were 2 asset classes, US Treasuries and the S&P 500. And it seems to me that it's a very behavioral process of how we add asset classes. Basically, enough people to talk to enough institutional investors and enough people come through their doors trying to sell them something, and after a bit they give in and say, oh, well, it's an asset class. And that wouldn't be such a problem. It does mean that there is change over time. But my real issue is not only is that distortionary, but the pace of change is slower than the pace of change in the real world. So the gap between our perception, according to what asset classes are, and the real investment universe is actually growing. So ETFs is just it's a problem. It's part of a much bigger problem of the way we use asset classes and indices to somehow represent lower risk building blocks.
I just want to ask you about the situation with the dollar and EM corporate debt. I manage a global equity fund, and I've had to look at all of this. Basically, QE in the States meant that the world was flooded with cheap dollars. And I've met companies from Brazil, Turkey, other countries, where the moves on the comprehensive income statement of their dollar liabilities are greater than their total net income. And they stopped showing the comprehensive income statements in successive investor conferences when they realized that that's what investors were tuning into. That even happened actually around the taper tantrum in May 2013. So today, dollar index has moved from 80 to 95, and it's heading up. It could go to 120. There's going to be an enormous currency mismatch on all these EM corporate balance sheets. I hazard that that's the reason why EM is a dirty word today, not a prejudice. It's because there's a massive fear out there that the bubble that was in US housing in the noughties has then got recycled into EM corporates.
Very good question, very pertinent. We've seen it all before, by the way. In Brazil, actually, in '02, one of the initial parts of the argument why Brazil was going to fall over was because they had all this dollar debt. And they weren't because of the dot-com burst in the US. This was after Argentina. The argument was they'd never get refinanced. And of course, they didn't get refinanced. But then apart from the guys that had actually been speculating, 2 or 3 companies, they didn't default. They just, because they had the resources. And then the problem moved on. I think you come today, and there's a couple of things I would say, first of all. Compared to the US junk market, I think emerging market corporate debt is amazingly safe for a number of reasons. The bulk of money which is raised, US corporate debt, and I agree that there's a currency mismatch, temporarily at least, is that you have expanding companies. And the level, what's really interesting is if you look at the debt as a percentage of the asset base of the companies, on average it's still been going down. In other words, the expansion which is of the real activities of the companies, which is financed by that debt, is still more than the increase in the debt. So that's point one, and that is completely different to the US corporate bond market, where basically bonds are being issued in order to refinance existing bonds. Yes, and that's a complete. Second point, to give you some comfort, is that when we had at Ashmore, we were still, I don't know whether they still are, but certainly the largest corporate debt, emerging market debt manager at the time. What was really interesting, at the really crisis points in 2008, we didn't have any liquidity problems at all in those markets. Now, an additional, which is a very interesting point, is that when yields got to a certain level, admittedly much higher than today, they were sort of low to mid-teens, when it got to that level, we saw a completely new investor base come into the market. Basically local investors that thought, oh, wow, that's interesting, I'm going to buy it at that level. So just looking at, again, the behaviour of Western investors with regards to what they perceive as important, without understanding that there's actually potentially a huge other investor base locally, is, I think, missing half the problem. The point is that, yes, there's sort of, I don't know what it is, 15 trillion in pension funds in money in the developed world, but it's sort of 5 already in emerging markets. And this institutional savings base is growing very rapidly. And the other point about the currency mismatch is, if you remember what I was saying about the dollar, that may very soon be, the logic is that they should be borrowing in dollars because basically the dollar's not going to be worth anything like as much as it is at the moment in 5 years. So there's a how do we cope with the volatility between here and then? But at some point, this is down to the stupidity and the inaction of central banks. The central banks, of course, what they should be doing is basically intervening in order to stop their currencies appreciating the dollar, and they can do that. And I believe they will do that the moment that everybody else is doing that, because you don't want to be held, you don't want to be left holding the baby, if you like those central banks think in 1971 that didn't ask for their gold back, right? You don't want to be in that position if there's a crisis. But you also don't want to go first. Say you're Brazil, you don't want to appreciate your currency, or even depreciate less than others at the moment, if you feel that the Koreans are going to nick your export business. But when everybody's doing it, that means follow the Chinese, then you will go at the same pace. And also, when you do it, the logical thing to do is when you sell your dollars, buy Korean won, push their currency up at the same time. So I think there's basically what you're seeing, your currency mismatch is a function of emerging market central bank, i.e. creditor nation complacency, which cannot be sustainable inevitably because the imbalance is just getting bigger and it will change at some point. My worry is that it happens all of a sudden and you actually get a massive, and there are some economists who said, oh, that's the optimal solution. Have a 40% devaluation of the dollar, and get it all over with. The problem is that might create so much uncertainty, it actually creates a depression. So you just don't want to me, it's just very imprudent advice. And I've heard economists say that, and I think, that's not wise. Better, get the problems out there. So in the short term, this is a question of complacency, I would say. Yeah.
Well, the final point is just that the energy in the US has changed the game. So if the US goes into current account surplus because of energy, that's also going to pull dollars out of the rest of the world, which wasn't there before in the previous scenario.
I'm a big fan of the United States, but I'm not that big a fan to think that's, that they're suddenly magically through their problems. They've still got massive debt, and they've still got major problems, I'm afraid. And they've done no structural reform. Yes, they've got cheaper energy, but that's it. They've done no structural reform at all.
Thank you very much for the speech. I'm just interested to know more about the independence of the emerging markets versus the developed markets. You talk about China being the biggest creditor of US debts, but what is useful if United States is in a situation not being able to pay the debt? And also, can you talk more about the fragility of the emerging markets and also the Chinese response to the slower growth and you know, the independence of the exports sector?
First of all, I mean, there's a lot of questions there. First of all, if you've got a failed trade and you know it to be a failed trade, there comes a point when you cut your losses. You know you're going to lose, but it's better than pouring more good money after bad. And that's the problem that central banks with huge dollar reserves face. Because the moment they think, oh, I've got to stop buying more, then they face the loss. So what do? Actually, what you do is you do sell, but don't tell anybody. So there's a lot of that sort of gaming going on. Fragility of emerging markets is in large part a perceptual thing. It's a small amount of fragility. Serious problems, fragility stops. And you get the 71 scenario. Completely different, step change policy change in the reaction function. You also ask about the slow growth in China, which is a very interesting way of putting it. And I mentioned earlier on that people had, in 2002, needed a reason not to invest in emerging markets, and that was Brazil at the time. And every 3 weeks, analysts would come up with another reason why Brazil was about to fall over, until they eventually realised that they could hold out longer than the hedge funds, and so they gave up. But China at the moment is actually in that role. People have a deep psychological need to walk out of this room and discount what I have to say, and not invest in emerging markets. And they'll come up with any reason. That's why the book has got all these different things in it. And China is a big part of that solution. It's a psychological. So we can spend another hour talking about why China has every policy tool to cope with the problems it's got, why it's done more structural reform than any other country developing in the last 10 years, why it's not facing a sudden problem in its export sector and therefore has to move to a consumption model of growth. It's actually been trying to move to a consumption model of growth. One of the consequences are that they move away from the export sector. Why, if you have a bad debt in China, and I take the word bank and I just rub that out and I call it social expenditure department, and suddenly the money goes out of that institution, it doesn't come back, and then central government bails it out, suddenly, oh, that makes sense, and that turns from being a banking problem. And remember, in banking problems, the real thing we're worried about is sudden stop of credit. It's not going to happen in China. It's not going to happen because the banks will get bailed out. So we'll actually move the problem from a banking problem to one of, can the national accounts bear the cost of bailouts? And the answer is yes. Will it affect their, AAA credit status? No. It's a very minor issue. Low growth in China of 7%. Wow. Well, again, historians might have something to say about that. If we had obviously a small percentage of that here, we'd be we'd probably be scared stiff about it being so fast. But meant the housing boom really was effective. And the questions about China are also, I think, in the context of the decision-making process. We can have all sorts of problems with it, but when they get consensus, they really do move. And I think there's a lot of also bargaining power. We're thinking about the dollar again. I think China really does have bargaining power today. This is why we've got this huge, great furore over the Asian Infrastructure Bank, which, of course, by the way, is a fantastic idea. I'm very pleased that the UK finally has something which we might call a foreign policy, because I was worried that we didn't have any. We just had domestic policy with foreign implications. We're actually in a world where, take the example of the dollar, which is where your question started. And the Chinese and the Russians have both actually talked about this sort of scenario. A lot of people go along with the US because of military might, but the thing works the other way. Economic power does have geopolitical consequences. If a US aircraft carrier gets a bit too close to Taiwan, then you might find that the Chinese might sell a couple $100 billion of US treasuries. What would happen? Well, we know from tick data, emerging market purchases of treasuries, not just, they've been holding up the dollar. They're so dominant in the capital account in the United States, certainly in major non-Fed purchases of treasuries. So dollar would go down. It would have a major problem. Then, aircraft carrier turns around. There's frantic phone calls to the Chinese. Chinese buys back the $200 billion at a profit and looks good. Now that's power. And they've talked about this scenario. And this is, to say, oh, well, they're just stupid emerging markets and they're going to lose their money because they're stupid enough to hold dollars. Yes, that's part of it, but they've also got some real power. The creditor nations may lose, but the debtor nation may lose more. Not least because they have low ability to weather, pain, actually. We are complacent. We are rich countries, don't have people who vote in accordance with their own interests. We vote in accordance with our consumer preference, it's all to do with self-identity, group identity. Our preference of reality is what sort of, whereas in emerging markets they vote for their own interests, they vote consistently when they get the chance against macroeconomic imprudence, they vote for low inflation. In a similar way, the pain ability, the pain capacity, if you like, of a Russia or a China is so much higher than ours that if we start sort of waging economic war, we're going to give up first, and they know that. This is why a lot of our policy thinking is so myopic. Sorry, I digressed a bit. Sorry, who's got a microphone? Yeah.
Jerome, that was fantastic, really. Worth coming with my crutches, I must say.
Well, thank you.
Your point about, I think the bottom line, what you're saying is really truth is painful. And obviously pensions are a fantastic example who have got such a low percentage of investment, who are genuine investors in terms of 10, 20, 30 years, have got a fraction of their portfolios in emerging markets, which should not be the case. And just kind of asking the question from a different stance, obviously, given your background, your economics background, plus the fact that you played the game in asset management industry. And as you would not be surprised if I told you that the CFA members here are very hungry for success and ambitious. Given what you know and what you've gathered in terms of your wisdom and experience, how should we look at it in terms of the evolvement of the asset management industry, and how we should align our sails to the new winds, if I may say, in terms of our careers? Thank you.
Well, that's what I wrote the book about. So that's the obvious, knee-jerk reaction. Read the book. But one thing I suppose I should really just pick on one thing. Most in emerging markets, one of the reasons why people don't invest a lot in emerging markets is because the publicly quoted markets are small compared to GDP. We use the word the investable universe. That's code. It means easy to invest in. It doesn't mean investable. And as Kennedy said, we should do the hard things because they are hard sometimes. And it's not, and often, I'm investing a lot in India. The IPO is the exit, right? It's after the entrepreneur has made their 20 times profit. And then, there might be another 3 times for the foreign investor. But actually, why can't we, as a multi-trillion-dollar industry, have the wherewithal to get access to the pre-IPO? That's what we should. If we're taking GDP investing seriously, that doesn't mean all crowding into the stock market of India. No, it means buying real investments. And that means doing it slightly different. That means getting sector expertise. Actually, what I've done in India, I've gone in not as a financial investor, but as a telco. And it means doing the difficult things. So I think we've got to learn to do that, and we've got to cooperate. We've got to set that as our goal as an industry. And yes, there's lots of research costs. Yes, there's lots of problems. But as an industry, we can pressure for that, and we can get it, I'm sure. So that's one idea.
Thank you.
Who's got the mic? There's one down right at the front.
From last one.
Okay.
Thank you very much for the wonderful speech. My question is about corporate governance. Some people say the standard of corporate governance in emerging market is lower than the developed world. Therefore, investing in emerging market is riskier. So what's your view on this?
Arthur Andersen, Enron, and above all, the fact that we know that's our perception. Therefore, we're pricing it in. So we actually look to that. We actually work out whether we've got a problem. So maybe we won't do a lot of small companies in China, to be honest. But we do like other places, and we do our due diligence. I think it's really interesting that when I was at Ashmore, there were cases of fraud and corruption, but always from Europe. It was banks in Europe, actually. If you go into an emerging market and say, well, I'm FCA registered, it's against the law in my country, I can't do anything, bang. You might get problems with bureaucracy, you might get problems with, but you don't get corruption. With corporate governance, I think there's a similar ability for us to demand better and only invest where we get better. And I think that's achievable, and it's very obvious that that is happening in a lot of examples. And that's, by the way, one of the main reasons why we should be welcomed. It's not the case that we should just think ourselves as a provider of capital, because let's remember, they are the net savers. They have their own capital. The problem is they've been sending it abroad. And we can provide competition of ideas, greater transparency, and help them improve the corporate governance. But as an investor, it's all about, again, it's about, have you perceived it? Because there's corruption, there's corporate governance problems, everywhere. There's political risk everywhere. It's not an emerging, these are not emerging market phenomena. Thank you very much.
Jerome, I think, in the interest of time, and I know that many of you have other questions, and I think, are you able to stay on for a little bit and have a quick drink with us and sign some of your fantastic books? Past. Wonderful. You have challenged our prejudices. You've challenged us to think, but we do, I'm pleased to say, I think, have a prejudice towards rigorous independent thinking. Perhaps we don't all use it as often or in its extreme form as much as we should. But I think you at least have given us plenty to think about, and I'm sure we look forward to doing that. So thank you very much. I'm sure you'd like to join me in thanking Jerome.